Next is a translation risk. Now, translation risk arises whenever there are assets or liabilities which are denominated in a foreign currency. Now, we know that any kind of foreign currency denominated items, be it asset or liability, they finally have to be converted into the respective firm's domestic currency. So there could be a conglomerate who has operations globally, but finally, let's say, for example, if we take of an Indian conglomerate, let's say Tata Motors, and the Tata Motors is based in India, so all of their reporting numbers will happen in Indian rupees. Now they may be having subsidiaries outside India as well, but finally, when they report the subsidiary numbers as a part of their Indian parent, they will have to convert these into INR. So whatever assets, liabilities, or any items which are denominated in foreign currency, they need to be converted into the firm's domestic currency for both financial as well as tax reporting purposes. Tata Motors was just one example. It could be any other company which is domiciled in any other country. A similar argument would be applicable there as well. Now, let's understand uh, how exactly translation risk will impact a company from the point of view of certain asset which is denominated in foreign currency and a liability. So let's start with the asset denominated in a foreign currency. Now, let's say there is an American company which owns real estate property in the UK. So naturally, they will be valuing everything in British pounds because that property is based in UK, so maybe London. Now, at the end of year one, let's say the property is valued at 10 British or 10 million British pounds. And let's say the exchange rate was 1.35. That is GBP USD exchange rate was 1.35. So 1 GBP was equivalent to 1.35 US dollars. At the end of year two, the property could be still valued at 10 million GBP, but let's say the exchange rate has moved to 1.25. That is, earlier we had GBP USD as 1.35, and now we have GBP USD. So let's say this was 1Y. Now at 2Y, we are taking it as 1.25. So we see a drop. So this means that the British pound has weakened or the US dollar has strengthened. You can put it anyway. So let's say we look at it from the prior perspective. That is, the British pound has weakened. Why we say that? Because earlier, one British pound was equivalent to 1.35 US dollars. Now, one British pound is just equivalent to 1.25. So that way, the GBP has weakened relative to the US dollar. Now, because of this weakening in currency, that is the asset which the company is holding has weakened. Now, because of this, the company in America will have to recognize a loss on its financial statement because of the movement in exchange rates. And how much would be the quantum of the loss? It's the difference 1.35 minus 1.25 into the property value of 10 million British pounds. So it will report a loss of 1 million US dollars on this asset, which is denominated in pounds in London. Next, let's try to understand what would happen for a certain liability, which is denominated in foreign currency. Now, again, consider an American company that has to take a euro 20 million loan. Uh, let's assume that the loan period is 3 years. I've just taken a hypothetical example, so the numbers are just made up. Now, the interest and principal payments are to be made in euros naturally, because if one is taking a loan in euro, then all of the periodic interest and the final principal payment has to be in euros itself. Now, the yearly interest transactions or yearly interest payments, they expose the US firm to what we call as a transaction risk, because relate this with the idea of payables and receivables. Now, whenever we talk of yearly interest payments, so think of these like your home loan EMIs. So, you know, just a synonymous idea. When we have a home loan EMI, we have to periodically make a payment to the bank. So, a similar idea applies here. If the US firm has taken a loan, then they're expected to periodically service the loan. And that periodical servicing is what we call as interest payments. So that gets classified under the gamut of payables and receivables transaction. And that's why we call this as exposing the firm to a transaction risk. There is a other component as well, because the final principal payment also has to be made, right? So that is what we call as a translation risk, because finally you have a asset. Now this can be seen from the terms of asset and liability, isn't it? Because At the moment we have taken a certain loan which has to be returned back. So that's why it falls under the gamut of assets and liabilities denominated in foreign currency, and that's why we call it as a translation risk. So we have, so again, just to reiterate, there are two facets of risk here. Transaction risk, because you have like a interstate payable, which is due at certain specific time points. And then you have a final payment, which will be repayment of the loan principal, which is like a liability which you're trying to return. So that's what we classify as a translation risk. Now let's start to put numbers to understand this better. Now, let's say the Euro USD rate at the end of year one was 1.2. That is, 1 euro is equivalent to 1.2 US dollars. If we value the loan using this, then it will be valued at 20 million euros into 1.2, which is 24 million euros. Sorry, 24 million US dollars. Now, let's say Euro USD rate at the end of year two is 1.15. Then the loan will now be valued at 20 million euros into 1.15, which is 23 million US dollars. So here we observe that euro has weakened relative to the US dollar, isn't it? So again, if we write it in our usual format, so we have euro USD initially at 1.2, and this is becoming 1.15. So earlier, 1 euro was equivalent to 1.2 US dollars. Now 1 euro is equivalent to just 1.15 US dollars. So that means we can say the USD has strengthened or euro has weakened. So we'll stick to the latter and we'll say the euro has weakened relative to the USD in year two. Now, because the euro has weakened, then that is of a benefit to the US company because of this FX movement. And because of this, it is going to report a profit of $1 million on its position. Because if we see the loan valuation has dropped, the initial loan valuation at the end of year one was 24 million, which has dropped to 23 million. So the US firm is benefiting by $1 billion because of this exchange rate movement. And that's why it will recognize a profit of $1 million due to translation risk. And this is how we can study assets and liabilities which are denominated in a foreign currency. And this helps us understand or get further insights into the idea of translation risk. Now, a couple of points to remember. Now, the transaction risk is going to impact companies' cash flows, whereas translation risk, although it doesn't impact cash flows, will definitely have an impact on the final firm's reported earnings. So this is something which you should remember for the exam. Transaction risk gets related with cash flows. Translation risk gets related with the firm's reported earnings. Now, also one brief note on how exactly transaction risk and translation risk from a hedging perspective will differ, or if you would like to contrast the way in which the techniques work. So let's walk through this so that we have a better view on this. Now, outright forwards, which we're familiar, they are very, very popular when we talk of hedging of transaction risks. So, for example, let's say we have a certain month over month risk exposure which we are trying to manage. Then that can be done separately using forward contracts. So that way, an outright forward could be used for managing the transaction risks. Now, if you're looking from a translation risk perspective, then this is advisable to be done in like a one-shot transaction, or it is better to do it at one single future date rather than a series of dates. Because if we keep on doing it intermittently along a series of dates, then that may result in over hedging, something which we don't really want to do because it won't really benefit the firm. So in case we are looking at a translation risk which we're trying to manage, remember that we will look at one single future date and we'll try to hedge our exposure accordingly. Now, firms are always concerned about the way in which their accounting profits are going to pan out because this is also relates to the idea of reported firms' earnings. Now, every firm will try its best to reduce the volatility of earnings, or they would want a certain stability in which their earnings are reported. So at that time, using forward contracts on the reporting date could make sense because that will eliminate the volatility which could impact the accounting profits. However, one thing to remember is that uh, now there should always be a certain plan in place in order to either sell a certain foreign asset or retire a certain foreign liability at a certain point of time in the future. Because honestly, what we're doing is whenever we are trying to reduce the volatility on the accounting side of things, that is, if we are trying to stabilize the earnings, not allow volatility to creep in, and when we use forward contracts, we are actually replacing one form of risk to the other. So the accounting risk or the volatility of earnings is being replaced by a cash flow risk. Now we say that because whenever we enter into a forward contract, there will always be a certain future cash flow which will be entered. So that's why we are converting one form of risk into another whenever we are trying to stabilize or reduce the volatility of accounting profits. So that way, having a very, very well thought out and well planned approach as to how exactly we want to handle foreign assets. So be it selling of a certain foreign asset or reducing or retirement of a foreign liability, that plan should be in place so that things happen smoothly subsequently, and the firm is not unnecessarily exposed to any subsequent cash flow risks. So this is a brief on hedging of transaction risk and how exactly we can differentiate or contrast this with the hedging techniques for a transaction risk. Also, an optimum way to manage a translation risk could be to finance an assets in a certain country with the borrowing in the same country's currency. So basically, what we are trying to say is try to fund the assets, or maybe your assets and liabilities need to be denominated in the same currency, so that any movements which happen in the currency will impact the assets and liabilities, and that impact will get netted off because the movements will be in opposite direction, right? It's an asset and a liability. So we have given an example here. So in case a certain company, let's say we have taken an Indian company which wishes to do some strategic investment in the UK, then it would be advisable to finance the investment in British pounds and then invest in the GBP denominated assets. So that way it will protect the company from protect the Indian firm from any kind of translation risk, because your assets and liabilities, they are denominated in the exact same currency, so they will offset each other. So this is considered as one of the more optimal ways of management of translation risk.